My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people want to make friends? I'm just trying to save you some money. My job is not just to entertain, but to educate and teach you. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. Remember Friday when we were all excited about Merck's new COVID drug? That night I told you this market has the memory of a monarch butterfly, so be careful. I was too generous. Monarch butterflies at least know how to find their way to southern Mexico before they die. This market's more like a lanternfly. It eats your money, and it looks like investors sense their duty, and their duty is to kill it. That's how I felt today with the Dow losing 324 points, S&P sinking 1.3%, but the Nasdaq tumbling 2.14%, where all the damage was. Now, here's a point worth remembering, though. As we go lower, the easier it is to go bargain hunting. But, of course, you still need to be careful. So what made this market so tough today? First, it's been so easy to make money in stocks for so long that lots of people forgot how to handle a sell-off. And there's lots of new investors suddenly who went out before they give up their gains. We forgot that there's a downside to the increasing democratization of the stock market we hear about all the time. Or to put it another way, democratization is an accelerant. When stocks are going higher, it's fabulous. The new investors are thrilled. They endlessly buy the dips or borrow money to do so, buy call options, because dip buying always seems to work. But when stocks go down and then don't bounce, well, that's another story. These people are now learning that a decline isn't necessarily a viable dip. It can be a draconian punishment that wipes out traders who bought stocks on margin or bought calls, expecting an imminent bounce. For nearly a year and a half, we had a raging bull market. It taught new investors that only idiots sell. Whenever I preach about taking some profit, standard practice for my charitable trust, I meet younger investors who school me about how foolish profit-taking could be. I'd explain that I simply didn't want people to give back gains. There's nothing worse than turning gain into a loss. But they told me I was too old to listen to, that I didn't understand the movement, that it was time for me to retire. I heard that endlessly. Nobody wanted to hear about the virtues of profit-taking or the need for discipline, making it so that you have some money left if the market goes down. We had a new market, they told me, a better market. My old ways were making it harder for people to try to make money. I was keeping people in their chains. Now, I practically begged people to realize that this was not a new market. It was the same old market, and eventually there'd be a reckoning because, well, there's always a reckoning. I even gave you a time frame. Historically, the market tends to swoon in the second half of September, and that weakness carries into the first couple of weeks of October. And that's why Larry Williams, the greatest technician of our time, told us the smart move was to sell around September 17th. Sure, you could see temporary blips up like we had last Friday. Do you know what? I expect another this week now that we're down 7.5% on the Nasdaq. That's right, 7.5% from the high. That's a pretty decent-sized decline. But I bet we don't find an investable level until later this month. That's what history tells us. This negative call wasn't rocket science, although maybe we need a new term now that even William Shatner's flying rockets these days. Real ones. It was simply a function of how the markets typically perform during this period of the calendar for the last 23 years. That's right, 23 years. Of course, these new investors would have none of it. They assumed I was operating in bad faith, trying to keep them from making money. That one really did take me by surprise. I've managed money and been writing about it for 40 years, with the latest being the CNBC Investor Club. My goal's always been the same. I'm trying to help you make the most amount of money with the least amount of risk. I don't want your money. I don't take your money. I want you to get rich carefully. Right now, there remains plenty of risk, although with the Nasdaq bruised and the overall market down 5% from the highs, I'm not trying to tell you, oh, here comes the sell-off. We can start looking for buying opportunities on the way down, but we have to buy stocks gradually on the way down, because if you just jump in on every dip, well, then you're going to get slaughtered. Beyond the disillusioned dip buyers, we got a second problem: the seemingly endless oil rally. Now, for the longest time, the bull market in oil was a terrific sign of strength. We didn't have to worry about economic weakness if we saw the price of crude going higher. But this is one of those practical jokes that the market plays on us. Higher oil is great for the stock market as long as it doesn't go too high, at which point it drags down everything. And with oil now at $77 a barrel, that's too high. It means we're in an inflationary nightmare scenario. Of course, it's not just oil, it's also natural gas. For the better part of a decade, we've had an oil and gas glut in this country. We were producing more of this stuff than we knew what to do with. Every time prices went up, the oil producers would spend a fortune on drilling, much more than they even had to spend, and new supply would push us right back down. Last year, though, these companies finally got religion. They stopped spending beyond their means. They got disciplined about keeping production low, and that's why their stocks have been on fire. Now they're no longer drilling like crazy with borrowed money. That means much less oil and much less natural gas, which comes to the surface when you drill for oil. So suddenly these fossil fuels are in short supply. We don't even have the pipeline infrastructure to get this stuff to where it's needed. Northeastern states have killed 5 pipelines in the last few years, which is why so much natural gas remains stuck in Ohio and western Pennsylvania. We can send it more easily overseas than we can to Boston. Long story short, when we see oil this high, we're now petrified by inflation worries. Meanwhile, there's been strong inflation for months, but nobody really cared until it started hitting gas prices. Of course, the flip side here is that if oil pulls back, the averages will roar. Again, while you see the bear mauling, you have to believe that the commodity indices won't hit all-time highs as they did today every single day. Don't extrapolate every negative trend. You wouldn't do it for the positives. Third problem with the market, tech is just out of this world bad for all kinds of reasons. Facebook's become a corporate pariah that can't even keep its own site running. I defended Facebook for its excellent work helping small business, and it's still doing that and doing a great job. But those leaked memos did take my breath away. Last week, I interviewed Salesforce Mark Benioff at a corporate governance conference I threw, and I asked him how he would fix Facebook if he had the chance. Benioff told me there's two kinds of companies, those who believe in the truth and those who believe in power. He thinks being a single source of truth is what matters, and that safety should be paramount. Clearly, according to the memos, Facebook disagrees. Now, my charitable trust has owned the stock forever. We are up huge in this thing. But I think it's time to let Facebook go. There are better opportunities. So check your investing club bulletins for more. It'd be hard to part with it. I mean, I created FANG, and that was the F, but it's not just headline risk anymore. As for the rest of tech, it's seeing tremendous profit-taking after tremendous ones, just profit-taking. And that's what just happens. There's nothing wrong but profit-taking. And you know why this is happening? As I said repeatedly, we've got too much supply. Lately, we've had a huge wave of IPOs, and most of these companies are about digitizing something or other. They've all started to blur together, which weighs down the entire tech edifice. Until the IPO market slows to a crawl, tech will remain under pressure. If deals get pulled, the good ones, like Salesforce, will come right back to life. But deals need to get pulled. Every day I come to work on the Post 9 at NYSE, every day I see more companies come public. Finally, there's Washington and the world. Washington's a nightmare. President Biden and his allies on the Hill seem incapable of pulling anything off, don't they? From the debt ceiling extension to the infrastructure bill, the Chinese keep flying over Taiwan's airspace. No one's doing anything about it. Against all these is Merck's COVID pill. Against all of this, it's a good start. And getting COVID under control is incredibly important, even for inflation. I think as stocks come down, we could be due for an oversold bounce. Nothing like lower stock prices to make the market more attractive. Plus, if oil prices ever go down, the averages will explode higher. Let me give you the bottom line. This market's already forgotten Friday's good news because of this. But, I mean, everyone suddenly realizes it's a tough market? I say tomorrow's a brand new day. Maybe we'll forget this ugly session, too. Nothing would shock me at this point. Now, we're about to get into one of my favorite parts of the show, and that's getting to talk to you, Cramerica. Last week, we launched an exciting initiative. It's called the CNBC Investing Club. This is an opportunity to get daily emails from yours truly. We sent a bunch today. You'll be able to see exactly how I'm investing in my charitable trust, and like, for instance, selling the Facebook. And yes, I'll also tell you when I screw up and how it went wrong, like I bought some other stocks too soon. Total transparency. Join my mailing list by going to cnbc.com/investing club or scan the QR code, which will take you right there. Club's going interactive, influenced by you. Let's hear what's on your mind. Let's go to Jack in Pennsylvania. Jack.
Booyah from Allentown, Pennsylvania, Jim. How are you this evening?
Well, I was in Allentown this weekend on the way to the Eagles game, and maybe wish I'd stayed there, frankly. What's going on?
Jim, I'd like to get your take on one of my favorite turnaround companies, and I think it's one of yours too, GE. Jim, what are your thoughts on the reverse stock split and also the purchase of BK Medical?
Well, BK Medical shows they play office. Reverse stock split, I wasn't sure whether that was necessarily the right thing to do. I know they felt they had too many shares. But I believe in Larry Culp. It's going to take a long time because they need Boeing, they need aerospace, they need COVID under control. A lot of things they need. I think they'll get them, but not that quickly. How about Steve in New Jersey, please? Steve.
Hey, how's it going, Jim?
Oh, it's going okay, Steve. How about you?
I'm holding tight.
Yep.
I have a question about my Oracle. It's my single largest stock position. And, I've noticed that several analysts have slipped in their ratings or reduced their ratings.
Right.
So I thought maybe I can, get some input on the stock.
No, I don't. Look, I happen to think that Oracle is incredibly well run. I don't think there's anything exciting. I don't think there's anything boring. I do prefer Dell over Oracle, but they've had a series of quarters that make me feel like Oracle is just doing quite well in the cloud and no one's talking about it. All right, Friday's good news. Already forgotten by the market, but tomorrow's a new day. Maybe they forget today's pain. Wouldn't shock me. These downside of democracy is really being with us. I say don't get too negative. That's a bear. That's a picture of a bear. Don't get too bearish. On Mad Money tonight, I was never an artist. Big Blue is gearing up for some big changes. I like that company. It's a year after the company announced its breakup plans. I'm checking with the CEO of IBM, get the latest on what these changes could mean for the bottom line. Could a dash of McCormick maybe spice up your portfolio down 15%? I'd say so. But let's speak to the CEO on what's known as National Taco Day. And after its recent report, Paychex has rebounded to just below its all-time highs. What a move it just had. I'm going to get a read on employment and the stock with the CEO. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.